Hey everybody, welcome back to Actual Investing. Today I'm going to be talking about 4 stocks that were suggested to me by my subscribers. I'm hoping to give a quick overview on each of these stocks, talk about my thoughts on it, whether I think it's a buy, and what I like or dislike about the underlying business. So without any further ado, let's just dive right into it. The first stock that has been suggested is GLBE Online, ticker GLBE. The subscriber says, "Great content, much appreciated. I would love to see a video on GLBE Online. They're a market leader in the rapidly emerging category of direct-to-consumer cross-border e-commerce. Market cap is $5 billion, and I believe it's a great potential multi-bagger. Founder-led business with world-class metrics. Shopify owns a large piece of the company. Would love to know your thoughts. Thanks in advance." So yeah, happy to take a look at this one. This is actually a stock that I am familiar with. I haven't done a lot of research on it, but we can certainly talk about it today. So the viewer made a great comment about what they do. They are a global e-commerce platform for cross-border e-commerce. And they do have a large partnership with Shopify. Shopify owns almost 13% of GLBE, and I happen to own Shopify, so I guess I technically own a tiny bit of GLBE as well, just through that. On their website, it says GLBE merges the 3 pillars of e-commerce acceleration. So enablement, so actually facilitating these cross-border e-commerce transactions, global intelligence, and global demand. So global intelligence is going to be things like analytics. The website also says that GLBE makes it simple for merchants to sell worldwide by managing all aspects of global e-commerce. There's where the name comes from, GLBE. So they say they cover it all while you focus on your brand and stay in control. So when we go to Shopify's website, we see their partnership with Shopify allows people who have Shopify Markets Pro enabled to use GLBE to sell products internationally. So that's pretty slick. So it sounds like it's a platform that is helping people expand the reach of their e-commerce platforms. And I am quite bullish on e-commerce. It's one of the big themes that I wanted to get exposure to in my portfolio. It's why I own companies like Shopify and PayPal. I think both of those companies are really powering e-commerce in a large scale. So let's talk financials now. Here's my spreadsheet, and this is a sheet where I rate growth stocks on 4 factors. Those are gross margins, annualized revenues, price to annualized sales for valuation, and quarterly year-over-year revenue growth. So these 4 metrics together, I think, paint a good picture of how a growth stock is doing and give me an accurate valuation of the companies. So on each of those 4 metrics, you get a score out of 5 for a total possible score of 20. I've never seen that before. I don't think that's even possible, but my average is around 12. GLBE gets a score of just 9.1, so that is quite low. So we're going to take a look and find out what financially is hurting GLBE on my spreadsheet for valuing stocks. So GLBE's gross margins do leave a bit to be desired at just 42%, and they are a smaller company at just a $5 billion market cap, like the commenter said, and smaller companies do get penalized on my spreadsheet because one of the factors is annualized revenue, which is obviously going to be smaller for smaller companies. What's also not doing them any favors is their valuation at 9 times annualized sales, which is not terribly expensive for a growth stock, but they are growing at just 24% year over year, which is not bad by any means, but it's also not anything to write home about. So financially right now, if we look at just kind of the rear view mirror approach, GLBE doesn't look like anything special. So I think if you were to invest in GLBE, you'd need to be very bullish on global e-commerce. And if you are, GLBE would be the way to go because they're partnering with some of these big brands to sell internationally. So they have partnerships with Hey Dudes, which is now owned by Crocs, DKNY. And I'm from the US, so I don't know a lot of these international brands, but they do have big partnerships with many international brands in countries like the UK, France, Sweden, Hong Kong, Germany, Italy, and more. They're leveraging this partnership with Shopify in order to continue to fuel their growth. They're expecting for fiscal 2024 to have revenue in the range of $733 to $773 million. And last year they had revenue of $570 million. So at the midpoint of their projections, that's 32% revenue growth. So their revenue growth is actually accelerating. I like to see that. So even though their valuation seems a bit steep for the growth they have now, that acceleration in growth is going to do 2 things. It's going to help out the growth section on my spreadsheet, and it's also going to help out the valuation section on my spreadsheet because with more revenue means a lower valuation and higher growth, that score I believe will go up. So I think GLBE is actually a better investment than it may appear if you're just looking at the rearview mirror. You need to look forward a little bit and see what they're going to do in the future. It's kind of nice because in the recent earnings report, they actually show how they raised their full year guidance. So that's nice to see. I always like when companies raise their guidance that shows that they are confident and optimistic about the future. So GLBE, I am personally not looking to take a position in that stock today, only because I already own Shopify, so I technically own it a little bit, and I'm very, very wary of adding new small and mid-cap stocks to my portfolio. I really try to focus on big, well-established companies, so even though GLBE does look pretty good on the surface, I'm personally not buying it. However, I do think it makes a nice, compelling investment for somebody who wants exposure to global e-commerce. All right, let's move on to Bloom Energy, which is a stock that I actually used to own when I began my investment journey. I was really excited by what they do. So Bloom Energy is a green hydrogen stock. So that's a technology that's a bit controversial. Some kind of seem to think that it's going to change the world, and some, such as Elon Musk, don't really believe there's any merit to it. But what is nice about Bloom Energy is they're actually implementing this today. This is not some pipe dream. This is something that they are doing. So Bloom's value proposition, what they do is they sell this always-on power grid to enterprises that really need continuous power. So think things where a power outage would completely cripple the organization, like a hospital. If a hospital has a power outage, that's bad news because they need power to keep people alive. It's a big deal. So things like hospitals and factories where downtime is a no-no, Bloom Energy steps in with their continuous always-on power grids. So they have this really nice little graphic about how the fuel cells work. So they're saying that the fuel cells that they use in their always-on grids, they essentially kind of look like a little wafer, I guess. They convert fuel into electricity, and this fuel comes from hydrogen, but it also comes from natural gas, so it's not purely 100% hydrogen. They stack these wafers together, they combine them to build a module, and then they link these modules together, which gives you this always-on microgrid. And here they note some notable customers like Home Depot, so they're helping Home Depot to never experience an outage. Equinix, which is a data center real estate investment trust, so to help these supercomputers always continue to go. So I think Bloom Energy has a lot of potential applications for data centers and clean energy. So two big investment themes of the day. Bloom Energy plays a bit in both of those. When we look at their revenue growth, it is slowing down. They're expecting at the midpoint $1.5 billion in revenue this year. And that is a growth rate of about just under 13%. So it's not like they're seeing extreme hyper growth, but it is still nice revenue growth going in the right direction. Their valuation is quite low at 2 times annualized sales, and they do have revenue over $1 billion per year. What is not great about Bloom Energy is their gross margins are very, very low at just 14%. Now, this makes sense. A hardware company is always going to have lower gross margins, and especially a very expensive piece of hardware. Bloom Energy's low valuation on a price to sales basis makes sense when you look at their low gross margins. What I also don't like is that they're not profitable, and they don't have a very clear path to profitability at this point. Two of the things that I look at in terms of how a company is spending their money is their research and development and their selling, general, and administrative. And both of these are higher than I would like to see. Selling, general, and administrative is actually higher than their gross profit, which is also an issue GLBE has. However, GLBE is growing faster, so you could argue that that money is seeing a return. And Bloom Energy's research and development is over 50% of their gross profit at 80%. So financially, I just could not invest in Bloom Energy. There's just way too many red flags for me to want to take a position. However, I do believe that the company is exciting and doing a lot of good things, but there's just something to be said about the lack of strong profitability. And actually, if we kind of look back, their gross margins do fluctuate, so it looks like they've actually been higher than 14%. They were even at 26% at the end of 2023, but then they've since dipped back down to 16%, so they're a little bit all over the place. But either way, that's a bit on the lower end. I kind of consider the minimum for me for an investment to be 20% gross margins, and that just helps companies compete on costs. All right, let's move on to Zillow Group. So another commenter says, thank you for the videos. Could you do one of Zillow, the prop tech company? And yes, I can. Zillow is not necessarily a stock I've ever wanted to get exposure to simply because I am a homeowner, so I do have real estate exposure through my actual physical residence. But it might be interesting to see how Zillow actually makes money. And to do that, I found this nice little article on Investopedia called How Zillow Makes Money. So Zillow Group actually owns Zillow as well as Trulia, StreetEasy, and HotPads. Some ways they make money are charging property managers to advertise their listings on Zillow's rental manager. so they're a bit of a platform for landlords. They have premier agent branding on their website, which is listing service search, client reviews, photos and videos for realtors, and they earn revenue when real estate agents purchase advertising on their website. So in their recent earnings release, they show how they break down the revenues. Residential is actually the highest, so that's things like their Zillow platform, and then they have rentals, and interestingly, mortgages is a segment of their business. So they actually do offer home loans to buyers of houses. So that's very interesting. So Zillow seems to be a diversified property tech company with most of their money coming from this residential segment. They have a shareholder letter, which I really like. I like when companies do shareholder letters. It just really makes it easy for me to go through and skim things, and I like these diagrams. So we see that residential is a segment that has been growing. I mean, we saw a little bit of negative growth here, but the trend is definitely upwards. Rentals seems to be a bit flat lately, and mortgages was actually declining until they suddenly had a spike again. So mortgage revenue may be tied to interest rates. It's interesting because, no pun intended, because as rates go up, they make more money, but fewer people are going to be willing to take out loans. So those two things sort of counteract each other. Zillow actually says that purchase loan originations were down 10% year over year based on their own internal data. So it's interesting that they are growing. That shows that they have a good position in the market. And their purchase loan origination volume is actually up, whereas everyone else's is down. So Zillow, clearly a leader in the property tech market. Let's look at their financials on my spreadsheet. We're seeing that they are growing steadily. This is not a typo. They had the exact same growth as Bloom Energy at 12.8% year over year. Their valuation is quite in line for a company that is still growing at double digits with a price to annualized sales of 5.4 and these really nice gross margins of 77%, which comes from being a platform company. There's not a ton of costs associated with capturing that revenue. They also get a green light on the SG&A and R&D, though both of these things together are over 100. The company is not currently profitable, but they are still growing, so maybe we can forgive that. Annualized revenue over $2 billion shows that they've captured a good chunk of market share. I think most people are familiar with Zillow, and probably if you talk to realtors who are in the industry, a lot of them have probably used Zillow Group's services. So Zillow Group, like I said, I own a home already, so I already have real estate exposure, so I don't own any REITs or any kind of property tech companies in my portfolio, and I'm not really interested in. However, if that's something that you want to get exposure to, I think Zillow also looks pretty good just on a surface level. Obviously, it makes sense to do some more DD, but hopefully this gives you a good start. I do feel like things are looking good for Z stock. All right, let's look at the last one. Another commenter says, I would like to see a review of Snow or S SentinelOne if possible. So I did talk about Snowflake a little bit in my recent video where I talked about 5 stocks that I'm buying in June, which I did recently buy some more Snowflake. So I'm not going to talk about Snowflake today, but I will talk about SentinelOne because I haven't talked about them before. So SentinelOne is a cybersecurity company at its heart, but it's also an AI and big data company. Their key competitor is CrowdStrike, and SentinelOne is kind of the junior of that relationship. CrowdStrike is much, much bigger than SentinelOne, and that's why I've always avoided SentinelOne. But I don't want to just dismiss them because of that. I want to look into what the business actually does and judge them on their own merits, not comparing them to CrowdStrike. So SentinelOne's 3 value propositions are maximizing visibility across the enterprise for security, protecting, which is defending their enterprise with unrivaled speed, coverage, and efficiency, and resolve, which is just using AI to respond to the entire connected security ecosystem. So similar to CrowdStrike, SentinelOne has an AI-enabled connected cybersecurity network. So when a threat happens to one of their customers, they can learn from that and use that to improve the offering for all their customers. So they do have economies of scale just like CrowdStrike, and we've seen that that's working out really, really well for CrowdStrike. What you get with SentinelOne is a valuation that's way lower than CrowdStrike. So their price to annualized sales is just 7.6, whereas CrowdStrike's is 27.5. Now granted, CrowdStrike is profitable and they are the larger player in this space, so it makes sense that they should have a higher valuation, but that's a way higher valuation, and I don't think that's entirely justified. Financially, SentinelOne is growing quite rapidly at about 40% year over year, and they do have really nice gross margins in the 70s. They are spending a bit too much on SG&A for my liking. Over 100% of their gross profit is going into SG&A. However, that explains their high growth number. Typically, you'll see these two things being positively correlated, a high expenditure in SG&A and high revenue growth. You need to advertise to grow, and advertising is part of the SG&A, the S part, the selling, right? So perhaps I could forgive that. SentinelOne also has a shareholder letter, which is nice. They talk about their Purple AI platform, which simplifies and accelerates the more complex tasks of cybersecurity. So these are things like threat hunting and investigating. And they talk a lot about this singularity platform that they offer. So essentially, they're combining all of these different services into one platform. So they have this Singularity platform, which is supercharged by their Purple AI algorithm. And then they have this data lake where they can store data about threats that happen and view their analytics, so they can see things like what types of threats are very common, how do we protect against these types of threats, what has worked in the past, what are these cyber criminals trending to do? How can we get ahead of them? So it's a really, really nice platform. And I like that they are trying to condense everything into one roof. Vendor consolidation is a big theme lately. That just means that companies are starting to use one vendor for multiple things instead of using a bunch of different vendors and trying to work with a bunch of people. So some companies that really benefit from this are companies like Datadog or Cloudflare, where they offer a whole bunch of different stuff under one umbrella. So SentinelOne, I would say, kind of joins that group with the Datadogs, with the Cloudflares of the world. But at their heart, they're still a cybersecurity company. And there's no shortage of cybersecurity companies out there, so you really have a lot to look at. So what do I like about SentinelOne? I like that they're growing more quickly than any of the other cybersecurities I look at. I'm invested in Palo Alto Networks, which is still growing, but definitely not anywhere near as fast as SentinelOne. However, what I would say to that is that SentinelOne still doesn't even have $1 billion in annualized revenue, so it's much easier to grow when you're a smaller company, and it's much harder to grow when you're a larger company. And that's just because when you're a larger company, you've already kind of captured all the low-hanging fruit, and it becomes more and more difficult to grow. And so you kind of tend to switch towards profit mode. So I think SentinelOne is kind of on its own playing field. I think companies like CrowdStrike, Palo Alto Networks, Fortinet, which are all very different companies, but are all cybersecurity companies, they've all started growing a little bit more slowly. Maybe CrowdStrike's the exception. They are still growing pretty fast, but compared to SentinelOne, they are growing a bit more slowly, 30% instead of 40%. So for me, I'm not looking to open a position in SentinelOne either, only because I already own Palo Alto Networks. I've owned CrowdStrike in the past. I'm just not looking to get extra cybersecurity exposure already. I also own Snowflake, which offers data lake and data cloud services, so I don't necessarily need that exposure from SentinelOne either. However, I think if you do have a high risk tolerance and you don't want to pay the astronomical valuation of CrowdStrike, but you still want to get exposure to AI cybersecurity, SentinelOne is probably not a bad bet. What you could also do is get a 50% position in CrowdStrike and a 50% position in SentinelOne, and that way you're covered either way. So just to summarize, I like GLBE, Zillow, and SentinelOne. I don't really like Bloom Energy, unfortunately, just because financially there's too many red flags. However, I'm not planning to open a position in any of these stocks, but I really appreciate you guys bringing them up to me so that I could talk about them, and hopefully this spreads the word on some of your favorite stocks so that people can become acquainted with them and know what they do. And it's just kind of nice to learn about new stocks. Even though I'm not going to buy them, I still want to know about them so that I can be aware of what's going on in the market. So if you liked this video, please hit that like button. If you disliked the video, hit the dislike button, and just leave me some constructive feedback about what I can do better in future. And if you're new to the channel, please subscribe. I post stock deep dives, stock analysis, just general stock videos talking about the bull and bear case of different investments. So if that's something you like to see, definitely join me. And if you are already subscribed, I do offer a membership. It's like $1.99 a month or something like that. I'd have to double check. It's about $2 a month. It's something that YouTube wanted me to do. I just got my first member. So thank you, Carlos, if you're watching. I appreciate that membership. And what I give you for that $2 a month is simply I post my trades as I make them in pretty much real time. So the first two I posted, I've already shared. I bought Ulta, sold First Solar. Both of those turned out to be, I guess, decent trades. I'm not saying that my trades are always going to be good, but if you're curious what I'm buying and selling, that's a way that you can get access to it before I potentially post a video on it. I do have 2 other trade alerts that members would be able to see, but I don't want to show them because otherwise that's not really fair to the people who are members, I guess. Anyway, sorry, shameless plug is over. Thank you guys so much for watching. If you have any other stocks that you'd like me to cover in the future, please honestly leave them down in the comments below. I love getting these suggestions, and I will respond to all of your comments. I hope you all have an awesome day.